Simon Erickson. Excited to have you here. As we mentioned earlier today, we are bringing back the Seven Investing podcast with a new and improved format. We're doing it in a live stream here on Riverside. You can always attend for free live if you want to be here and ask questions or talk about the companies. We're also sending it out there to our Twitter at Seven Investing, at Seven Innovator on Twitter, and then at Seven Investing on YouTube. If you do want to follow along, we're going to be following along with company-specific insights and updates. This morning, we're going to be talking about, and today is May the 6th, 2025. We're going to be talking about Wolfspeed. The topic of today's is what is going on with Wolfspeed. The ticker on Wolfspeed is WOLF. As of right now, it is trading at $4 per share, and it has a market cap of $622 billion. This is one of the most volatile stocks in the entire stock market. Seems like at any given day, it's either up or down 20%. It's just extreme volatility. There's a lot going on with this company. I want to dig a little bit deeper into what's going on because the company not only has completely restructured itself and has shut down certain of its fabs and then opened new ones, but it's also just had its CEO has been replaced and its CFO has also stepped down. And there's some financial stability concerns that I think investors should be aware of before we jump in and say, hey, look how cheap the stock is right now. Not that anyone is doing that because the stock never seems cheap. It just seems like it keeps going down. But what the heck is going on with Wolfspeed? Well, let's go back to the Wall Street Journal because just last month, they published an article, Wall Street Journal Pro, on April 23rd that says that Wolfspeed is has one of the highest short interests in the entire stock market. Again, a short interest is defined as the percentage of the free float of shares that are being sold short. Free float means if you take out the shares that are held by insiders, they're not available to be traded on the NASDAQ exchange. Out of those that are tradable, 41% of them right now are being sold short. They're being lent out to people who are betting on the stock price going down. That is extremely high. Typically, for a growth stock, a high short interest would be 8 or 10%, maybe even 15 or 20% if there's a lot of pessimism around a certain stock. For Wolfspeed to have two out of every five of its shares now being sold short in the publicly traded stocks that it has out there, that is extremely high. There's not very much confidence from investors right now. And we dig into this and we say, why is this? Why is this one of the most hated, most shorted stocks in the market out there? We look at a couple of things. The first of all, this is a global leader in silicon carbide production. And so silicon carbide, I've talked about this previously on the podcast. It's a wonder material. It goes into a new wave of chips, typically for power conversion. And there are certain applications that really want to have efficient conversion of power. One of them being electric vehicles. The traction inverter needs to have silicon carbide for converting the direct current that's produced by the battery, converting it into alternating current that's necessary for the motor. And so EVs were supposed to be one of the natural fits for Wolfspeed. That has certainly not played out the way that they expected. They've got a lot of great relationships and long-term partnerships with some of the largest automakers in the world, but certainly it's been sluggish in terms of the demand for EVs versus what Wolfspeed was expecting. Now that's a problem because making chips requires building factories, and building factories cost billions of dollars. And so what did Wolfspeed do just a couple of years ago, even just 2 years ago? It goes out there and it borrows a whole lot of money because it's expecting that it's going to need to supply a whole lot of silicon carbide to fulfill demand for EVs. And so what it does is it's very exciting. It goes out there and it raises a lot of long-term debt and it raises a lot of convertible debt. And I want to take a closer look at those specifically for this podcast because it's got $3.5 billion of long-term debt on its balance sheet right now. And in addition to that, it's got another $3 billion in convertible debt. And so this comes directly off the quarterly report. The long-term debt, the $3.5 billion of long-term debt, is broken down into two different parts. The first is actually a pretty good shareholder-friendly use of financing. It's called a customer refundable deposit. So Renesas, one of its larger customers, it goes out there and it says, hey, we'd like to borrow money from you. We'll pay you an interest rate. Right now, this year, it's at 6.8%. That's below market rates for what Wolfspeed could raise on the debt markets currently. But it says, hey, we want to raise $2 billion from you, a customer who is interested in seeing us succeed because you want access to that volume and to that supply of silicon carbide. And so Renesas goes out and gives it a less than market interest rate, 6.8% right now. That's going to rise at 15% annually. Next year in 2026, that will be 7.8%. 2027, it'll be 9%, continues to go up. And Wolfspeed, of course, can pay this down at any time. So this was actually not something I have any issue with. This was a smart financing agreement to get financing from one of your larger customers at a below market interest rate that's increasing over time, but it's also on a steady schedule. So far, so good, in my opinion. The thing is a little bit more concerning for shareholders is the 2030 senior notes. This is traditional debt that it went out there and it raised from kind of more traditional financiers. Apollo was one of the larger lenders in this. And it's got $1.5 billion of debt that's on the balance sheet today. That's not due until 2030. These are senior notes out there. But the problem is that they kind of, when they issued this in the first place, it was under the assumption that Wolfspeed was going to be getting a lot of funding that wasn't going to be needed to be paid back from the CHIPS Act from the US government. The Biden administration considered this to be a national interest to have domestic production, especially for silicon carbide, especially for electric vehicles. And so they were going to give a loan, not a loan, an award of up to $750 million directly for Wolfspeed to build these factories. And once it was issued, it was considered that up to a third of that loan that was raised from the CHIPS Act, a third of the funds raised from the CHIPS Act would be used to repay the loan that was issued from this consortium of financiers, including Apollo and others. If Wolfspeed did that, the interest rate would fall to 9.8%, traditional financing, traditional debt. If it did not happen, the interest rate could balloon much higher, up to a maximum of 15.875%. And it doesn't take me to tell you that that's a very high interest rate. And that's exactly what Wolfspeed is paying on that $1.5 billion of debt right now, because they did not get the funding from the CHIPS Act that they were promised. Of course, we've got a new administration in the White House now. The Trump administration seems to have zero interest in actually paying this award that was promised by the Biden administration out to Wolfspeed. So Wolfspeed is now stuck since it didn't receive that $750 million in CHIPS Act funding as an award. I don't think it's going to come through. I think it's going to be stuck with this very, very high interest rate debt that's now almost 16% that it has to pay back. And then the third tranche of financing, if you will, is the convertible debt. It's got $3 billion of convertible debt. This is in addition to the other $2 billion of the customer financing from Renaissance, and then also the $1.5 billion of the senior notes for 2030. Is now on top of both of those, got $3 billion in convertible debt that's available too. And this is less onerous. This isn't so bad. It's only got an interest rate of about 2% right now, because the original investors were looking forward to converting it into common shares. Right? This was traditional debt up front, that if the stock price hit a price of equivalent of $118.88 per share, it would then convert into common equity, which of course would dilute us as shareholders. You now would have a whole bunch of new shares that would be issued from the conversion of the debt, but also with the stock price today at only about $5 a share, it doesn't seem like it's going to hit that threshold of $118.88 anytime soon. So I think this is going to remain as low interest rate traditional financing that's going to be stuck with debt instead of conversion into common shares. So here's where things get complicated, right? Wolfspeed has got, not the cash flow internally to pay back all of its commitments. It is certainly still producing negative cash flows, and it's got the interest payments for all of those debt financing requirements. And the problem is recently we've been seeing this debt on the secondary market kind of selling it at far below par value, far below the rates that they were issued at. In fact, several of them are now only 30 cents on the dollar. I jumped in earlier this week, actually last week, with a special situations expert. We looked at the Bloomberg terminal. A lot of the existing debt that they had on the secondary market, where debt financiers can kind of swap with one another the corporate debt that they have on their books. A lot of these are now paying out interest rates of greater than 30%, as opposed to the 9.8% as what we were expecting it to be. Then it was up to 16%, and now several of them are even paying 30% coupon rates in terms of the interest yields that it's getting for the debt. So that's a really bad sign. It's a red flag. There's not a whole lot of confidence from investors, equity investors, because we've seen Wolfspeed's stock price falling so significantly recently. And there's also not a whole lot of interest or confidence from debt investors, seeing that the debt is selling at much lower prices, much, much higher yields, because the prices that debt investors are willing to pay are only 30 cents on the dollar in many cases out there. And so you look at all this and you'd say, okay, that's great, Simon. Why then, if everything is looking bad and we've got all these problems that we've got with Wolfspeed, why then, sir, has Wolfspeed's stock price doubled here within just the last month? You've seen the stock price at just as of recording right now is trading at $4 per share. It went up from about $2 a share as recently as April the 16th, right before all the bad news was hitting out there. Why has the stock price doubled in less than a month? And I think the reason is because no one wants to see Wolfspeed go bankrupt, right? The debt holders don't want to take a huge loss, even though in terms of the payouts there before equity investors, if you're a debt holder, you get paid first, but they probably would be only refunded, maybe 30, 40 cents on the dollar for the debt that they had. Nobody wants that to happen. And as equity holders, if we're buying the stock on the NASDAQ right now, we don't want to get completely wiped out. We want to make sure that they've got an agreement where they can get what they need and the stock can continue trading without going through Chapter 11 bankruptcy proceedings. Nobody wants to see this go under. And so what is going on? Well, Chris, the Wolfspeed's newest CEO, has come in now. He says, okay, let's bring some lawyers to the table. Let's see what the opportunities are for us to recapitalize this business. Let's see if we can renegotiate some of that debt that right now we're paying 16% or higher on because of the debt commitments that they have. They didn't get the CHIPS funding, the things like that. But let's look at the picture of where it stands with Wolfspeed right now. I want to lay it out. I want to make sure we understand where do we stand and what is this going to mean for us as investors. Just to hit a couple of the important bullet points, Wolfspeed has got $1.4 billion in cash. That is okay to certainly get it through the year in terms of its operating expenses, especially considering that all of the restructuring charges and all of the shutting down of the factories and the layoffs that they went through are kind of behind them now. We're now trying to figure out what is a new steady state for this business, keeping in mind it's certainly not going to be what we expected it to be when we put out kind of those aggressive forecasts a couple of years ago. But $1.4 billion in cash, attempting to collect up to $450 million of an award granted by the CHIPS Act. This would not have to be repaid. This is not a loan. This is an award from the CHIPS Act, of course, promised by the Biden administration. Going to be harder to get it out of the Trump administration, but it's still legally binding. It's also, in addition to that, trying to collect another $865 million in cash tax credits from the CHIPS Act. Again, that was directly related to building its Mohawk Valley facility up in New York. That was a very expensive new fab that was built under commitments of the CHIP Act that they would be getting direct cash credits of up to $1 billion. They've already put a couple of those and collected a couple of those. There's $865 million worth more, again, in cash in the form of a tax credit that Wolfspeed's going after. In addition to that, they just like I said earlier, downsized a lot of its business, closed down its existing North Carolina fab, reduced its operating costs, reduced its headcount, and again, the debt that it does have on the books isn't maturing until 2030. It's about 5 years out, so we've got a little bit of wiggle room here to figure things out in the short term. And so to wrap this all up, I don't want to go too long about Wolfspeed, but I think that this is a very messy situation. I think that investors should be proceeding with caution right now. I really liked Wolfspeed's optimism 2 years ago when in 2023 they were saying, hey, yeah, we're going to hit $4 billion in revenue and a 20% cash flow margin by 2027. Unfortunately, that seems very unlikely now. And I think that's one of the reasons that Greg Lowe has stepped down as CEO, and then also CFO has just recently stepped down this last month. I think that things did not go as planned. And to be fair, this isn't entirely Wolfspeed's management's fault. Certainly, they didn't hit what they promised. They didn't hit their forecasts that they put out there as the strategic goals, but they also didn't get the funding they were looking for, not only from the United States government, but also the German government, from certainly some of their customers who were scaling up much slower than they expected. And then just generally the macro was just kind of a tough recovery from 2022 when interest rates went higher, when there was definitely not the financing that was available that they thought there was going to be. And then now we have a new administration that's making things more difficult for them. So I think let's start with the glass half empty here. I think the worst case scenario is that Wolfspeed would find that its existing debt loans are completely unmanageable and it's unable to find a viable solution on how to pay all of this back. When you cannot pay your debt back and there seems like there is no solution to finding to this problem, you declare Chapter 11, right? This is bankruptcy proceedings, wipes out equity shareholders, worst case scenario. The debt holders try to figure out who's going to get what as they kind of figure out, what is going to get chopped up of the company's assets and then divided out. Doesn't mean the company gets completely liquidated. It could still be a going concern. It's just very, very bad as they'd have to recapitalize worst case scenario for equity holders like us. The best case scenario would be that Wolfspeed actually does secure the funding from the U.S. government, right? The CHIPS Act pulls through and not only gives it about $860 million in the tax credits, but it even makes whole with that $750 million of the grant that it was going to award for the Mohawk Valley fab. That would be fantastic. That'd be $1.5 billion of financing that could come at very attractive rates, if not an award completely upfront. That wouldn't have to be paid back. That would be the best case scenario. That Wolfspeed now has got a whole lot of capital coming in that it can continue to do what it wanted to do in the very beginning. And most likely, it would take at least some portion of that $1.5 billion in cash and pay down a good portion of its 2030 senior notes, perhaps up to $1 billion worth of it, so that it could reduce the outstanding interest rates and, of course, the amount that's due back to its traditional financiers. So that's the worst case, would be Chapter 11. The best case would be CHIPS Act pulls through. I think neither of those is actually the most likely, though. In my opinion, the most likely scenario is that Wolfspeed does not get the CHIPS Act funding that I thought it was due, but it also finds a new financial partner that is not quite so onerous in the terms. I don't think it wants to be paying 16% interest rates out there right now. And I think it's got some good assets in place. And I think it's got some good technology in place. And it's got some good customer relationships in place. It's got some good long-term contracts in place. And let's not forget, this is not just a small company. This is the global leader in silicon carbide supply, right? It's not even just electric vehicles. This could have a great use in industrial applications, for HVAC applications, for anything where there's electrification and power conversion that's required. Wolfspeed certainly could find itself at a very lucrative niche of the market. It's just a matter of, who wants to get in now when it seems like it's the worst case scenario and you're buying debt cheap or you're buying equity cheap. So I think there's going to be a new financer that's coming in. I think this is the option that the management team is looking at right now. I do think on the table is going to be that $1.5 billion of the 2030 senior notes. I think they're going to roll those into a new financial package. It's going to have a lower interest rates, but probably some other kind of terms attached as well. And we'll see what those look like. But I think that if you're Wolfspeed's incoming CEO, if you're Wolfspeed's new incoming CFO, this is the options that you're looking at. We don't want to go bankrupt. We don't want to really stick it to our equity partners or our financial partners out there. Let's find something that's going to work at the best for everybody and get back to business, knowing that we've already reduced the footprint of this business and closed a lot of the operating facilities down as it is. So that is what's going on with Wolfspeed. Here, it's been 17 minutes we've been talking about this. Again, kind of getting under the hood, seeing what's going on with the financial statements, seeing what's going on with the stability of the company. It does seem pretty dire out there. I'm not going to recommend any investors go out there and immediately buy shares, but I also don't think this company is completely doomed yet. We haven't even seen bankrupt proceedings. We haven't really seen that outside of speculation being discussed by management as one of their options right now. I think they really are going to try to refinance a lot of that debt and restructure the capital structure of the business before they kind of proceed that. And it's going to be interesting, right? BlackRock and Apollo and all these that are debt holders, they might try to push for liquidation because they want to make sure that their needs are considered here and that they're getting the best deal they possibly can. Maybe that would be a liquidation of the company, but I do think it's in the best interest of everyone to keep an ongoing concern and seeing if things can swing back as the pendulum goes a little bit more optimistic. So that's Wolfspeed. Again, WOLF. This is on the NASDAQ, about a $622 million market cap, selling at about $4 per share today. You can follow along with this one on our 7investing site, 7investing.com/WOLF. Just like any other ticker out there, you can just put 7investing.com/the ticker symbol to follow along with our coverage. If you want to see our conviction rating, we rank everything from best buy to strong buy to buy to hold to potential sell to sell for every company in our research universe, Wolfspeed included. You can see that with the 7investing membership. If you want to get set up for absolutely free, 7investing.com/subscribe, where your first 7 days are absolutely zero cost. So my name's Simon Erickson. We looked at Wolfspeed today. We got a lot of earnings to get through this week. I'm excited to go through all of them. Check out 7investing.com, and thank you for listening to our new and improved podcast. We're here to empower you to invest in your future. We are 7investing.